In this video guide, I'm going to give you an easy explanation of how the stock market works. We're going to cover how the stock market actually works, why companies sell stock, why investors buy stock, and how to actually go about buying stock. How the stock market works. So companies on the stock market are said to be public. The stock market allows public companies to sell shares of the company to investors. A share basically represents a portion of company ownership. Since there's usually millions or even a billion or more shares of a particular company, one share, it's a very, very small fractional portion of the company. So what's the point? Why would anyone buy these? Why do companies sell shares? Really, what drives the whole thing? And let's first talk about why companies would want to sell portions of their company to you or to other investors. And the primary reason is to raise capital. So let's say you owned a successful business and you had 10 locations and you were doing very well, but even if each location made good money, if you had to buy a new building, every time to build a new location, you might only be able to create, a new location once a year or twice a year. So what if you were to sell half of your company to the public through the stock market in the form of shares? You could then take that money and build another 10 locations in that same year. And then that extra income would let you build even more locations and more locations. So that's one of the reasons that companies sell stock, and that used to be the primary motivation behind companies selling stock. And now, especially with the rise of venture capitalism, a lot of times companies go public just for the owner and early investors to profit. This is not necessarily a bad thing. A lot of times companies these days get all of their startup funding through what's known as a venture capitalist or a private investor, someone who puts up money on a company that's, just an idea or just needs some money to get started, and they're not ready to go public yet. The company will, or the venture capitalists will put up the money they need to get started, and in exchange for that money, they'll get a portion of the company. And then down the road, as the company's grown, if it's successful and the company goes public or gets bought out, the venture capitalists can, sell their shares or sort of cash in on their early investment. And for the owner or the founders of the company, let's say you have a very successful company and it's worth $5 billion. But if you're the owner and you own the company, that doesn't mean you have $5 billion in your bank account. It means you own a company worth $5 billion. And if you wanted that $5 billion, you'd have to sell the company. Well, if you instead sold a portion of that company through a stock offering, you could still own the majority of the company, but then sell some of your shares for money for, personal use. So it allows owners to enjoy success of the company without actually selling the company and giving it up entirely. And finally, companies sell stock in order to reward employees. A public company can, rather than just pay cash to its top performing employees and executives, it can give them shares or stock options in the company. That way they can kind of pay their employees more without actually dipping directly into revenue. And that can help, that high payoff can help retain talented staff without dipping into the revenue that's being used to drive further growth. So, it's pretty clear at this point why companies sell stock. The question is, why would anyone want to own stock? And as I mentioned before, stocks represent ownership of a particular company. But when you own a stock share, you don't actually get a say in the day-to-day operations of a company just because you own those shares. Some companies have a stockholder meeting once or twice a year where you can vote on particular issues, but even those votes don't necessarily mean that the company has to take that action. Just that the board of directors might see what the shareholders want and sort of weigh that in their decisions, but it doesn't actually mean that the company is going to take the action that the shareholders vote on. So the real reason that people buy stock is because if shares represent a company, if the company grows and becomes more profitable over time, so does the stock. So an investor might buy stock during initial public offering, thinking that the company is going to grow over time, and then if it does, sell it later for a profit. And investors buy a stock that's already public down the line because they think it's going to grow even more. So that's how it pretty much works. Once those shares go public, they can trade hands as the company grows or declines. So does the share price. And another reason people own shares aside from growth is for a dividend. And a dividend is a cash payment that some companies pay out, particularly very mature companies that are no longer in a large growth phase. So they use some of their earnings to pay their shareholders some money. It's as if you own if you owned a portion of the company, a dividend basically allows you to take some of that company's profit for yourself as a shareholder, just as if you were the real owner of the company. So sometimes investors buy stock just for the dividend, or they're hoping for a little bit of both. They're hoping for some share price growth through earnings growth and some dividend growth through, earnings growth diverted to the dividend. And dividend investing is really profitable over the long haul, particularly if investors take that dividend and use it to buy more shares of the stock. And that's, there's a lot of stocks have programs for that, and they call it a dividend reinvestment program, where the dividend is automatically reinvested back into more shares. And that's a very profitable way to invest over the long haul. So while you may be ready to jump into the stock market after seeing all the positives to buying stock, there's also some risk. And the main risk is that the stock can lose value over time. The stock can even lose all value if the company the shares represent goes out of business. And stocks lose value when investors think that the company is no longer as good as it once was. And the obvious cause of that is if the company makes less money or its business declines. But sometimes stocks can still lose significant value even if they're doing well. If the company was projected to do amazingly well and it didn't quite live up to those expectations, its stock could lose a lot of value, even if it was continuing to grow and generate more profits over time. To clarify, let's say investors thought a particular company was going to grow by 50% every year, and instead of growing by 50%, it only grew by 30%. That would be a devastating blow to the stock's price, even though 30% growth of a company is pretty nice. So you have to consider that risk exists when buying a stock. So now that you know why people buy and sell stocks, you might wonder how you actually go ahead and buy a share of a stock. And it's very easy to do this. You can just set up a free account on a discount brokerage site. I use Etrade, but there's many competitors that all do the same service, like Etrade, and a lot of financial places like Fidelity or TD Ameritrade have discount brokerages too that you can trade through. And usually what they do is you can buy and sell stock through their platform. They'll handle the transaction for you, and they'll do it for an $8 to $10 fee, something in that range. And that's how they make money. And you own all the stocks; they're yours, but you just buy and sell them through their platform. They're the ones that are synced into the stock market. And when you actually go ahead and buy the stock, what you do is you pick the stock you want to buy and you put in a buy order through the site. Every site's different, but it's pretty simple, really. Once you signed up, it's amazing how easy it is if you've never bought stock before. The only two things that you really should be careful of is, one, be sure you use what's called a limit order. When you go ahead and buy a stock, you'll have an option to buy it at market or buy it at limit. And if you buy it at market, you get whatever the price is at the current second. And stocks often go up and down a couple percentage points in a single day. So if you buy at market value, you might get on that high end, you might pay a couple percent more than the stock's really averaging around. If you put in a limit order, you basically set the maximum price you're willing to pay for a stock. So you can set that under 1% under what the stock is trading, and most times you'll get it. The stock will naturally fluctuate down to that level as it moves up and down throughout the day. So if you're patient and use a limit order, you can often get a slight discount on stocks. If you pay market, you'll often overpay for a stock. Another thing to consider is there's multiple markets on which you can buy a stock. For example, there's the New York Stock Exchange, which has most of the stocks listed in the United States, but there's also the NASDAQ market, which has most of the technology companies in the United States. And many of these companies have similar symbols or similar names. So make sure you have the right stock selected when you actually go ahead and put in the order. Just double check. It happens a lot with new investors. They don't realize what they're actually buying. So the next question might be, how much money is required? You know the risks, you know how to buy stock, you know why people buy stock, you know why companies sell stock. But the real question is, what do you need to put in? And ideally, you want to put in at least $1,000 into a single stock transaction. And that's because since discount brokerages typically charge $10 to buy and $10 to sell, that fee will eat into your return if you don't buy too much, if you don't buy enough at once. With a $10 trading fee on $1,000, that's 1% of your return is automatically gone to the buy fee, and another 1% is automatically gone to the sell fee. And if you only invest $500, it's 2% to buy and 2% to sell. If you less than that, it's even more. If you invest $100, it's 10% of your investment to buy and 10% to sell. At that point, it's not even worth doing. It would take, even with good returns, it would take 2 years to get your money back. So as a result, anything less than $500 is really not worth investing into an individual stock. You really want to do 1,000. I mean, 500 is okay too if you're going to hold it for a year. It's not too bad, but anything less than that, you might as well save. So finally, really the most difficult part of stock investing is actually picking, good stocks. And, that's kind of beyond the scope of this video. Ideally, we want to pick companies that are going to do well over a period of years and try to ignore the day-to-day price fluctuations and the day-to-day headlines. I put a link to my site where I discuss this further. And it's really, if people are willing to pay more for companies that are doing well and companies that are growing, just try to look at the world around you and see where companies are likely to go over time. I really like to invest in industries that are growing, that people are adopting. I try to set, for example, e-commerce. People are buying more things online. I want to invest in e-commerce. I want to buy Amazon. Less people are buying things in retail. I don't want to own a department store. That sort of thing. I mean, just, use your head. Sometimes there's value investors that try to, find these companies that people are passing on just because they seem out of date. And sometimes that can work out and sometimes it doesn't. So, everyone's got their own sort of theories on this, but that's my general take on it. And if you're still not sure, I have the How to Invest HQ portfolio. I just started it. And what this does is it's a public portfolio. Every month I put in $500 to $1,000 or so, maybe a little bit more depending on the month. And then I purchase a stock or I add to positions I already hold. And all that's displayed completely publicly. It's real money, it's real positions, and it's just something so you can see how I'm investing and see how it works. It's with a small sum that's not going to be crippling if you lose it. And with that said, stock investing does have risk. Don't invest your emergency fund. Don't invest, if you're getting ready to retire, don't buy a bunch of individual stocks. Use your judgments. Any money you put into the stock market, you have to consider there's a possibility that you could lose some of it or even all of it. And keep that in mind. So if this video was helpful for you and you now have a good idea of how the stock market works, go ahead and subscribe if you want more stock and investing videos and follow my blog for more great articles. Thanks.